Good afternoon, everyone. We are now in the March 5 trading session, and today is a day that could mark a very significant turning point in the market. What we're seeing is that the Dow Jones Industrial Average has officially broken below its 150-day moving average. Over the past 5 to 6 trading days, we've repeatedly issued warnings about this risk. And now that warning has finally been validated in the traditional industrial sector represented by the Dow Jones. Why did we previously say that the market had not fully digested the Middle East conflict? Because investors have been constantly trying to price one key question. Is this just a short-term conflict? Or is it something that could push energy prices higher for a prolonged period of time? The market has been going back and forth between those two possibilities. Today we received new developments. During an interview, Iran's foreign minister stated that Iran had attacked a U.S. aircraft carrier and several naval vessels, and he also directly responded to questions about potentially blocking the Strait of Hormuz. On the surface, his official statement emphasized maintaining freedom of navigation and claimed that Iran had not blocked the Strait of Hormuz. But in reality, the tone of the statement signaled something else to the market: preparation for a prolonged conflict. He also stated that Iran is ready for a ground war and that their goal is to drag the United States into a long-term military quagmire, similar to what happened during the Iraq War. Because of this, one word has started echoing again in the minds of traders: stagflation. The shadow of stagflation is returning to the market narrative. We've discussed stagflation before. Back in the 1970s, when geopolitical tensions in the Middle East escalated dramatically during events like the Iran-Iraq conflict and the Persian Gulf oil crisis, energy prices surged sharply. Those higher energy costs then passed through the economy through a complex chain of transmission, eventually driving widespread inflation. At that time, Federal Reserve Chairman Paul Volcker implemented extremely aggressive monetary tightening. The U.S. had to sacrifice employment and consumer demand in order to finally suppress that stagflationary environment. But the question now is, could stagflation return today? To answer that, we need to look at two sides of the story. And today's market movement actually gives us an important clue about what the future economic landscape might look like. Why? Because as we've discussed many times before, traditional industrial sectors are the most sensitive to rising energy prices. Energy costs directly affect production input costs for factories. For industries that rely heavily on commodities and raw materials, the impact can be extremely significant. For everyday consumers, you might not immediately feel massive price increases in daily goods, but for bulk commodities and industrial inputs, the increase in costs can be very large, and the impact on those industries is much more severe. So today we can see something very clearly. Previously, we drew a channel on the chart, a consolidation channel. I mentioned before that the move where the Dow briefly broke above 50,000 could essentially be ignored, and we even marked that section with a box to filter it out. Under normal circumstances, this channel should not have been broken in the short term, but then the war escalated. As oil and natural gas prices surged, the shadow of stagflation returned, and that has had a very significant impact on the Dow Jones Industrial Average. Now, the key question is, what does it mean that the Dow has broken below the 150-day moving average? If you only look at the structure here, technically speaking, the upward channel hasn't completely collapsed yet. It's not fully broken. However, how the market closes today is extremely important. Right now, we're looking at the 4-hour chart, but if we move down to the 1-hour chart, something becomes very clear. The S&P 500, the Nasdaq, and the Dow Jones are showing completely different price structures. The Dow's rebound is much weaker. If nothing unexpected happens, tomorrow's bounce will most likely fail to fill the gap above. In other words, the market probably won't close that gap. So even if we see a rebound tomorrow, if the gap remains unfilled, then the probability increases that the trend structure on the 4-hour and daily timeframes will break down. And once that happens, the market could enter a very sharp correction phase. So at this point, we're no longer calling it a level 5 alert. Once the air raid siren goes off and the bomb has already dropped, the warning stage is over. The impact is already here. So the question becomes, why didn't the Nasdaq and the S&P 500 fall as sharply today? Why were their moves relatively mild? The reason is something we discussed earlier. Right now, the global economy is being driven by two main themes: war and geopolitical conflict, artificial intelligence. And the AI wave is still moving forward at full speed. There's even a somewhat dramatic way some analysts are describing this war, that AI is increasingly involved in directing and executing military operations. Whether that statement is exaggerated or not, it highlights one thing very clearly: AI's influence on the future of society is going to be enormous. Now let's look at today's market. Broadcom's earnings report came in positive, and overall the semiconductor and chip sector performed very well today. The structure across the sector still looks very healthy. For example, if you look at Micron Technology and Nvidia, their price structures are still operating within the upward channels we drew earlier. We've had those channels marked on the chart for quite a while. Generally speaking, when I draw technical levels or channels, I rarely adjust them unless the structure truly changes. And right now, the structure remains very healthy. Higher highs continue to form, higher lows continue to form. So going back to the main point, AI is still the strongest long-term investment theme in the current market. Yesterday, I did mention that investors should reduce exposure to some of the high-tech AI software plays, but what we're seeing today is interesting. In the current market environment, AI and semiconductor exposure is actually starting to behave like a defensive allocation. A few days ago, we even recommended a very defensive stock, a company that produces eggs. That's basically defense within defense. To make it easier to understand, we can think of three levels of defensive assets. The lowest defensive tier, meaning not fully defensive but still relatively stable, would now include AI and semiconductor stocks. If we look at one representative ETF we mentioned before, the North American Software ETF, iShares Expanded Tech Software Sector ETF, IGV, it has been rebounding for many consecutive days. In fact, if you count the candles, there have been 8 consecutive bullish days. And more importantly, it has now successfully confirmed its support level. So what is the overall market structure right now? Capital is rotating out of traditional industrial sectors that are highly sensitive to energy prices and inflation, and moving into high-growth technology stocks. That's why, in my framework, these tech sectors belong to the third tier of defensive assets. So then what would be the second tier of defensive stocks? Those would be global superstar companies, companies whose business operations and supply chains are spread all over the world. A classic example we often recommend is Tesla. Tesla is exactly the kind of stock that should be included in a defensive allocation. Why? First, its industrial layout and supply chain are no longer dependent solely on the U.S. domestic supply chain. Even though it may still face higher raw material costs when energy prices rise, its overall production and supply chain are globally distributed. In fact, its ambitions even extend beyond Earth itself. That's why I categorize it as a second-tier defensive stock. Other examples include companies like Google and Apple. These companies also have global supply chains, global business operations, and they still belong to the high-growth technology category. So then what would be the most defensive assets? The first tier. When war breaks out, the first things investors usually think of are assets related to gold and precious metals, assets directly linked to the US dollar, essential consumption sectors, food, housing, transportation, daily necessities. As we've discussed before, sectors tied to basic human needs deserve special attention, especially food and agriculture, healthcare, essential consumer goods. These are areas investors should watch closely. Now let's talk briefly about the future geopolitical situation. I'll share a few personal views. First, this war is unlikely to end quickly. It began very suddenly, and the decapitation-style strike has created extremely complex political consequences inside Iran. Whether it's moderates or hardliners, both sides may now feel compelled to unite and commit to a prolonged conflict, even if that means confronting the broader international community. Why? Because Iran controls one of the most critical choke points in the world, the Strait of Hormuz. You may have noticed that over the past couple of days, the South Korean stock market has rebounded sharply. But in my view, that rebound could simply be a temporary bounce before further weakness. If you look at the Nikkei 225 in Japan or Korea's Kospi Composite Index, the impact from energy shocks has already been very significant, and this kind of economic transmission will eventually feed back into the United States. After all, the U.S. is fundamentally an import-dependent economy, so investors should prepare for a prolonged conflict environment when thinking about portfolio allocation. 2 words will define the main investment theme for 2026. I won't say it will last the entire year, but at least during the first half of the year, the key theme will be defense. Because at this point, you can no longer realistically expect interest rate cuts. Rate cuts in the first half of the year are extremely unlikely. No matter how strong employment data might be, as long as the war continues, the probability of rate cuts remains low. So investors should stop betting on rate cuts. So the next question becomes, can technology stocks still be bought? For example, AMD, Nvidia, yes, they can still be allocated. AI and semiconductor stocks are still part of the portfolio. But remember the framework we discussed. First tier defense, second tier defense, third tier defense. All 3 layers should be included in a balanced allocation. As market conditions evolve, we will continue sharing more detailed allocation strategies, including some of my personal portfolio approaches and positioning ideas. That's all for today's U.S. stock market update. We'll continue the discussion tomorrow.